But let's broaden the conversation out with CIC Wealth's Malcolm Ethridge, who's with us now, too. Malcolm, it's good to see you again. I hope that you've listened to this conversation that I've had with Tom, and I'd like your response to it.
Yeah, I mean, you guys covered a lot, man. I was ready to jump in there. But, yeah, I would say I hope this number coming in today higher and breaking another record puts a lid on the peak inflation debate. I think it's overdue, right? I don't understand what the peak inflation people are even basing this on at this point. To your point, if meat and dairy prices have increased something like 12 to 15% year over year and they're still climbing, fuel prices are up over 50% year over year and still climbing, almost $8 a gallon out on the West Coast. How do we know we're at the peak of anything, right? So this could also make it that much easier to make the statement that you just laid out there, that we are in the middle of a recession and just don't realize it yet. Because to your point, if a third of U.S. households making over $250,000 a year are reporting living check to check, then what the heck is happening to the people making $150,000 in household income? And that's a much larger percentage of the population. And also, those are the people that are more likely to be spending every dollar that's coming in, trying to keep up with inflationary pressures. And so if those groups of people with that level of income are telling us that it's a recession, they're not shopping at Target, sales are down. They're not shopping at TJ Maxx, sales are down. They're not shopping at Walmart, sales are down. That's the Main Street indicator that tells me we're already in a recession. We just don't want to admit it to ourselves yet. We want the party to keep going on because it's felt
does
really
it mean? Forgive me for stepping on your toe there, Malcolm. What does it mean for where stocks ultimately go from here? Because, I mean, that is the question of the moment. Everybody is thinking about the same question. What does it mean for my stocks? I'm thinking about longer-term investments, college savings plans, retirement plans. We're all in the same boat. We're all worried about sort of what the environment is heading into, what it means for the stock market. What do you tell people?
Yeah, I would say if you're a person who is actually expecting to need to tap into the savings that you have that are in the market today, maybe this trading range we find ourselves in, $4,000 on the S&P up to, what, 4,300 or so. We've been meandering in this trading range for like 3, maybe 4-ish weeks. Maybe this is the range where you start to look at that exit ramp and say, you know, I need this money sooner than I thought I would. This might be a place to get out, even though it doesn't feel good. If you're a person who's thinking more long-term, the next 12 months or so, you have to worry about tapping into that savings, then this doesn't really matter because we start to get positive earnings toward the back end of the year. We start to see, companies focus more on profits and surge our way back out of this, and you're fine. But it's the folks who have a more short-term time horizon actually need to be tapping into those dollars that they have invested that should be reassessing that time horizon and deciding whether they should not be in this market right now and heading for the exits.
It's hard to feel good about even the long term, Tom. I think you can understand that, even though you think that the second half of the year is going to be better than a lot of other people think. If you are looking at a storm developing on the horizon, you're assuming it's coming your way. Now, it may blow over. It may come over the mountains and break up. We just don't know. So it's awfully difficult for people to get their arms around this idea that the second half of the year can bring us to a point where we can go up 900 to 1,000 S&P points if we've got all these issues in front of us, Tom.
That's right, Scott. I mean, bottoming processes are very difficult for people because in people's mind, the math is, if you're already down 50% and you're down 55%, you've just lost another 10%. And that's why markets feel so choppy right now. But from another perspective, I just think that we've got a lot of positioning, cautiously positioned for investors. And if things are improving, I would say you're right. It's choppy. I think it's actually constructive that we didn't make new lows. Technicals are really important, and our technical strategist, Mark Newton's done a really good job helping clients tactically here. But again, what I would just caution investors is not to just give up on equities, because at the end of the day, the best performing asset class in an inflationary environment is actually going to be stocks, because nominal earnings will grow. I know there's going to be a lot of questions about companies having to cut earnings, but at the moment, I would just say you have to keep in mind if companies are able to pass on price, which is why we are seeing CPI, they're not the ones that are going to have the earnings problems. It's ultimately where we start to exhaust demand. And so far, that is not, the entire economy. It's more showing up in things like cars and housing. And those are the things actually the Fed wants to see start to slow down.